Markets are an absolute free fall today, but if you've been paying attention, you've been watching the channel, you know. This is exactly where we expected we would be at this point. Over the last couple of weeks, maybe a month or so, we've been pointing out that the underlying flows, the main driver of price, has really just been falling off a cliff, and price just kind of continued to push higher May, June, early July, and so we were expecting very soon that we'd be seeing the sort of volatility that we are. If you are relatively new to the channel, make sure you check out the video from a week ago where our deep learning model had been predicting all the way back from April, this exact moment in time for a sell-off. And if you want kind of more a theoretical understanding of where we're at, check out a month ago. Flows are collapsing. Again, some good explanations of exactly why we thought we would be here at this moment in time. And really, I have nothing more to say. I mean, it's playing out exactly as we expected. Flows are the primary driver and no real surprise. Now, as markets are collapsing, I mean, I will say certainly today's employment data is not helping anything at all, but there is one thing that has kind of surprised me, and it's less to do with the unemployment data. We did write an article at the beginning of the week where we were saying, and this is again over at the appliedmmt.com website on July 8th, that look, we've been seeing a softening economy on the back of some slowing down fiscal spending. No real surprise here. But the thing that is starting to surprise me, the thing that certainly surprised me, is what happened on Wednesday with the FOMC meeting and what came out afterwards with what Jay Powell was saying. Now, look, MMT made the call 2 years ago, or at least we were making the call. Those of us who are active in markets, who understand this applied MMT approach, we were making the call that the higher interest rates in 2022 were ultimately going to cause a boom in the market. We've been saying that the Fed and the mainstream macroeconomists have this backwards, and we have the receipts too. I'll make sure and link this below, but here was my post at the end of 2022 saying, hey, I think the rate hikes are ultimately going to cause a big surge in the economy, in part because of the additional interest income that would end up flooding the economy. And lo and behold, it's exactly what has played out over the last 2 years or so to this point, or 18 months or so at this juncture. So my question is, why is anything going to change now? Why, if the Fed, who now looks quite likely to cut almost 100% now, locked in to cut in September, possibly even 50 basis points in September, why would rate cuts now stimulate the economy when it was very clear that MMT was right and it was the rate hikes that stimulated the economy? So that's what we're going to talk about tonight, and the implication of kind of really a surprise to me that we're going to see what could now be a rate cut cycle. Had you asked me, maybe even 2-3 months ago, if I thought, and certainly at the beginning of the year, I didn't think cuts would end up being on the table at all this year, but certainly over the last couple months, we've seen maybe some slightly slower than expected data, and I had maybe thought we could get a single 25 basis point cut in before the end of the year, and I didn't think that would really derail anything at all. In fact, even a month or two ago, I would have said, nope, by the end of the year, we'll probably still be flat. Certainly by the beginning of 2025, we'll start to see a rate hike cycle once again. Now, I want to be very clear. I still think that is probably a 60-70% likelihood, and still is what my kind of current thesis is. But I do think there is an alternative reality that is becoming more and more likely, and that is that the Fed actually goes on a rate cut cycle sufficient enough to get us into a period that really is not going to be too dissimilar from, say, the 2010s. I'm going to explain all of it, why I think MMT is right on rates, what the Fed is thinking on rates, and what I think the implication is going to be if we do end up getting these rate cuts through. I think the big thing is, what is the Fed looking at? What do they think is going to happen with rate hikes or rate cuts? What do I think the impact of kind of rate manipulation actually is? And then let's kind of understand what the actual implication of that is and how that will transmit through the economy, and then how we can understand, depending on what the Fed comes out with in September, what the likely path is going forward. So in kind of economic 101 or macro 101 theory, the reason the Fed cuts or hikes rates is really just to change the behavioral decisions of businesses and consumers to go ahead and get a loan or not, making that loan more expensive or not. So the theory is, hey, if we hike rates, that's going to slow the creation of loans down, and therefore that'll slow business activity and get us out of the way of inflation or any negative effects of increasing business activity. I won't even go into kind of the ethics or morals or policy of that. I'll let that stay. Let's just say that's the right thing to do for the sake of the argument for now. And so they think higher rates are just going to essentially make things more expensive and business activity will slow down. Now, the MMT counter argument to that is, yeah, higher rates are going to make things more expensive, but they also come with the additional interest income to support the more expensive prices. And that's exactly what our thought was at the beginning of 2023, that this additional multi-trillion-dollar wave now of interest income would support this higher price level. And that's exactly as it played out, right? And so the question is, if this is how things actually played out and MMT was right, what do we think lowering interest rates is actually going to do? Now, I do think there is still this counterintuitive piece to this that says, well, wait a second, lower interest rates should just make cheaper loans and make wanting loans even more appealing because they're just cheaper. But why do businesses get loans in the first place? You or me, we might need a loan for something like a house or something like that. It'll probably be the biggest loan on a personal level that we ever take out. And so housing might be a kind of its own little situation, but for the vast majority of loans that are accounting for business activity, the main reason businesses are going to take out loans are because they think they can make those loans profitable, right? They think that they can increase production or whatever they need to do to increase output to go ahead and make more profit. And why would a company need to continue to increase profit in a business scenario? Well, that's to beat their competitors and also to beat inflation or the future cost of doing business that gets baked in. And so even though it seems intuitive that lower interest rates would encourage you to take on risk, there's actually no need, or the need diminishes greatly. There's only maybe one facet of need to actually take on more risk, and that is the competitive environment of just a capitalist economy. But that other element of needing to continue to increase revenue in nominal terms year over year diminishes in a low interest rate environment. Why is that? Well, let's think about this from just raising rates. If you raise rates, what is that doing? Yeah, it's making things more expensive. It's increasing the entire term structure of prices into the future. Everything is now more expensive, right? So if you're a poker player, I love poker tournaments. If you're a poker player, a good analogy for this is, in a poker tournament, the blinds and the antes are constantly going up over time. It's forcing the action, right? Over time, if you are just staying steady and you're not willing to take on slightly more risk, the fact the price of doing business is just increasing over time, it's going to eat away at your potential to survive in that environment. That's exactly what happens in an economy at the macro level when interest rates increase. It forces higher risk because now not only might your competitor beat you, but time itself is going to beat you because the present value of today's income is just going to be less into the future. So you're more inclined to take out more loans. It is pushing you up that risk curve, and kind of the classic Minsky cycle, the investment curve starts to shoot higher because the risk is there. Well, what happens? What is the feedback loop when you start taking out a loan? The feedback loop is that actually increases profits itself. So you end up getting a growing economy as private debt as a whole begins to take off, and you get this big credit cycle that ends up playing out. So higher interest rates are actually the necessary ingredient to kick off a credit cycle. That's exactly why we're seeing a credit cycle play out. Now, when you flip that in reverse, the whole thing happens in reverse. You now only have competition with everyone else at a flat term structure prices over time. You don't have the present value of your cash diminishing at a faster and faster rate. And so the other side of the risk, or this other kind of risk opponent here, if you will, at the poker table of a poker tournament analogy, it's no longer there, right? We're staying at steady blinds, steady antes. And so you can play a different strategy over time. So that is kind of the analogy and the way things work, and why from an MMT perspective, we certainly think that higher interest rates, yes, they make things more expensive. Yes, they make the kind of current valuation because of various cash flows less today, but they also supply the additional interest income, and it all washes out. Essentially, there's just new winners and losers when rate hikes occur. So, as we start to see rate cuts, the question is, should we expect new credit demand to increase? And this is where things just get tricky. I really, this is, I mean, everything following 2020 has been certainly a new example of something that's never happened before, and we are very much once again there. So, going back to the Fed, what is the Fed looking at more than anything right now? They've been very, very clear that inflation is really the thing that they are most concerned about right now. And initially, in the big inflation surge in 2021, 2022, their initial concern was the inflation surge to go ahead and kind of solve that problem. And now they're looking at maybe disinflation being a little bit too much, and so that's why they want to actually cut rates. So inflation has been the main contributing factor to the decisions the Fed is making. But I think they have it all wrong. I don't actually think that inflation in any way was ever impacted one way or another by rate policies. And the way that I'm going to show this is by looking at the global supply chain pressure index that the New York Fed puts out. Overlay that with the CPI level, and what you get is a very strong correlation. It's very, very clear that going all the way back to COVID, going back to the year of shutdowns that we had, the long time that it took to reopen everything, we had this massive, and then the invasion of Ukraine by Russia, spiking oil prices in 2022. We had this compounding event, supply chain issues, one after the other. And we had this transitory inflation. It's exactly transitory, right? We had inflation spike with supply chain pressure, and that supply chain pressure eventually gave way, allowing CPI to come back down. Ironically, I actually think it was in part because of the interest rates going higher that allowed the supply chain issue to go ahead and resolve itself so quickly. Now, it's not because, and I have proof of this that we'll show in just a second, it's not because credit demand completely collapsed. It's because the additional interest income from the private sector or into the private sector allowed all the supply chain issues to immediately get resolved and then immediately kick off the next credit cycle, which is exactly what we thought would end up playing out anyway about a year and a half ago. And if you look at bank credit, you can see that bank credit starting in late 2023 really started to reaccelerate. And so we've seen this strong reacceleration of bank credit. We saw deficit spending just absolutely take off in 2022 and into 2023. And we just had this massive wave of new profits that allowed supply chains to really correct themselves, new investment to come on board, and ultimately did solve the supply chain issue. And so based on Fed policy, I really don't get why they think they need to cut. Whatever, they're going to cut, they're going to do what they want. But what actually solved the problem was inflation getting solved in part, one, because it was just transitory and it was always going to resolve itself. Two, we've had this massive growth wave that has just allowed new supply, new production to come online to just create more products that can be consumed, and that has solved the initial inflation wave. Now, if the Fed continues to hike rates, I actually think we can shift from a transitory into an actual structural inflationary increase, and I still think that is a realistic possibility, and I would still say is probably my higher possibility than not outcome, but we'll save that for a minute. Suffice to say, everything the Fed thought they were going to do with rate hikes didn't actually end up playing out, and the data is certainly showing exactly what MMT thought would play out is what has actually played out. So this also kind of goes to now just kind of the bigger picture. We've looked at that the Fed looks at inflation. We've looked at that one of the things the Fed looks at is growth. We've seen growth in terms of, say, bank credit really take off here. So these are the things that the Fed weighs. Certainly employment as well is another facet of this. And I can go ahead and bring up that employment chart as well, just to kind of show that these are the things the Fed generally correlates with in terms of the decisions they're making. But they are very keen on looking at this inflation measure right now as their main input. So what it's really going to come down to is, can we end up getting inflation picking up fast enough before the Fed really goes into overdrive with the rate cuts? And if the Fed is able to go into a rate cut kind of overdrive, or something like oil really continues to collapse, that could just put us right back into a lower interest rate environment. And and ultimately the credit cycle is never really able to get going. And that is one distinct possibility now that I really think we have to say is more probable than it was certainly just a few months ago, and certainly a lot more probable than it was at the beginning of the year. And so I think that's kind of where we are at, that the Fed has it backwards in just a series of ironies stacked on top of ironies. By cutting rates now, the Fed could really be bringing an end to a very good thing that we were starting to see, which was just this kind of booming economy. But here's why I'm still kind of on I don't think that's ultimately what's going to play out. I do think that by early 2025, we will get an inflation surprise, and we will ultimately get the Fed to say, yeah, we probably actually need to start hiking rates one more time. And we've seen this in history where the Fed cuts and then decides very quickly to go ahead and start back up on a hike cycle. It's been a while since that exact sort of scenario has played out, but I do think we could easily end up seeing that. Part of the reason is we are just seeing a very strong credit cycle. And you can see the Fed follows the credit cycle. And the reason for that is the credit cycle also pushes forward the inflation cycle. And so we're finally starting to see this very strong credit cycle take off. I guarantee in the not too distant future, instead of seeing these surprises to the downside in inflation because global supply chains have finally resolved themselves, we're going to start to see that kind of find its next kind of surge higher as demand gets higher because of this credit cycle. So there will be so much demand that demand will outstrip the ability for supply. And that's just the ebb and flow of the supply chain cycle. And that will start to increase inflationary pressures, normal kind of business cycle inflationary pressures, which will then in turn give us some surprises to the upside in inflation, which in turn will signal to the Fed that, yeah, maybe we shouldn't be cutting because they have the whole rate thing backwards. And then we end up finding ourselves back into kind of what I thought at the beginning of the year we would, which is this reinforced rate hike cycle thing into then 2025. So a bit confusing because we're countering what the Fed is doing. We're countering how the markets interpret what the Fed is doing. We're saying that that's backwards. We're also trying to understand in the context of all that where markets are headed and what the implication of what the Fed is doing on markets might be headed. But I hope that all made sense. I know we covered a lot. I guess I will summarize with this before we sign off. Look, I don't think, even if the Fed is able to get a full cut cycle in, even if we end up slicing rates all the way down to, say, 2.5 or something like that, that will really end anything. I think we have had a sufficient reset of the global balance sheet scenario where we just are so flush with cash in this system, so flush with treasuries in this system, which are the safe asset of the global economy, that we should have a good, strong business cycle in front of us for some time to come. But the dynamics and how that looks into the future might end up playing out a little bit differently than I would have originally expected if the Fed can end up getting that cut cycle in. If, however, the other alternative ends up playing out and we do end up seeing inflation surprise to the upside, then I think we could start to see that spiral upwards of inflation caused by and reinforced by higher rates, and that remains out there as a distinct possibility. But I do want to say I don't think it's complete game over yet for the markets at all, or kind of the longer term outlook. But I do think it changes the kind of the direction of how that growth will ultimately look into the future. So I think I covered a lot. If you have any questions, leave a comment below. I know this can get a little confusing and it can be a little bit difficult to explain. So if there are pieces that just are not connecting, make sure you ask. We can get into this in future updates. And if you are an active trader, active investor, make sure you head on over to appliedmmt.com. See all the tools, research, analysis that we have available over there. Beyond that, make sure you hit subscribe, hit that like button on the way out. And until next time, good trading, everyone. And we'll talk to you then. Bye-bye.